Hello, everyone, and welcome back.
Hey there.
A huge thank you for coming to watch the video today. We know how busy things are, so we really appreciate you spending your time with us.
It is great to be here, and we have a massive amount to cover today.
We certainly do. We are breaking down the Maersk Q4 2025 earnings call. And, if you follow global trade even a little bit, Maersk is basically the bellwether.
The bellwether for the entire global economy, really. If they sneeze, the supply chain catches a cold.
Exactly. And this call was a big one. It marked a transition in leadership, closed the book on a volatile 2025, and really set the stage for what looks like a fascinating and honestly a pretty rocky couple of years.
It really was a packed call.
Yeah.
You had the CEO, Vincent Clerc, leading the charge, and it was also a bit of a changing of the guard. This is the final appearance for CFO Patrick Kiani.
Right, he's stepping down after 6 years.
Yep, and Robert Ernie is set to take the reins.
So, here is the mission for this deep dive. We're going to unpack the prepared remarks first, get the lay of the land on the financials, the strategy. Then we'll look at the outlook for 2026, which had some pretty specific warnings.
Yeah.
And then, and this is the part I'm really looking forward to, we are going to do a detailed walkthrough of the Q&A session. We'll look at exactly what the analysts asked, name by name, and what Maersk's answers tell us.
That sounds like a solid plan. There's a lot of nuance in those questions.
Okay, so let's start with the rearview mirror. They closed the book on 2025. How did the numbers look?
Surprisingly strong, actually, considering how chaotic the world was last year. They hit the upper end of their guidance.
Okay.
Full-year EBITDA came in at $9.5 billion, and EBIT, that's earnings before interest and taxes, was $3.5 billion.
That's a lot of cash, but where's it coming from? Is it just moving boxes on ships, or is that diversification strategy starting to pay off?
That's the key nuance here. It's not just the ships. The logistics and services division really stepped up. They improved their margins to 4.8% for the year. But the real MVP of 2025 was terminals.
The ports.
The ports. It was a record year for them. Revenue grew 20% and EBIT jumped 31%.
That is massive growth. It seems like owning the infrastructure is a good hedge when shipping rates get wobbly.
It really is. Now, for the ocean segment, that's where you see the complexity.
Right, their bread and butter.
Exactly. Volumes actually grew nearly 5%, so they're physically moving more stuff. But they were fighting against receding freight rates for most of the year.
So more work for less money, basically.
In a way, yes. But the big story in ocean wasn't just the volume, it was the operational side. Specifically, the implementation of the Gemini Network.
Right, Gemini. This was mentioned constantly. For those who haven't dug into the logistics weeds, can you explain what that is?
Sure. Gemini is their new network collaboration model. I mean, think of it as a complete rewiring of how they schedule and route ships to prioritize reliability above everything else.
And it worked.
According to the call, it's a major success. They hit 90% schedule reliability.
Wow, 90%. For anyone who has tried to ship a container in the last 5 years, that sounds almost fake.
It is unheard of in this industry. But here's where it gets really interesting financially. They revised the cost benefits upwards. They managed to deliver that volume growth not just by buying more massive ships, but by increasing asset turns.
Asset turns. Let's unpack that. That's basically efficiency, right? Getting more out of the ships you already have.
Precisely. It basically means they're driving the taxi faster and more efficiently, rather than just buying more taxis.
I like that analogy.
By moving cargo faster, they generated over $300 million in benefits in Q4 alone, mostly from things like lower bunker fuel consumption because they aren't waiting around in queues.
That efficiency is going to be critical because when they turned to the outlook for 2026, the tone shifted dramatically.
It did. Cautious is the right word, maybe even bracing for impact.
So what are they guiding for?
They're guiding for global container demand growth of 2% to 4%, which is, decent but not explosive. But financially, they are predicting an underlying EBIT somewhere between negative $1.5 billion to positive $1.0 billion.
Wow, that is a wide range, and it dips significantly into the red. They are essentially saying they might lose money on the core business next year.
They are, and they expect free cash flow to be above negative $3 billion. This all reflects the reality of industry overcapacity, too many new ships coming online, and of course, the uncertainty around the Red Sea.
And with that kind of forecast, they had to make some tough calls on capital allocation, didn't they? The buyback.
They did. The dividend is safe. They proposed 480 Danish kroner per share, a 40% payout ratio, but they tapped the brakes in the share buyback.
How much?
It's continuing, but the new tranche is reduced to $1 billion. They explicitly said this was a move to be Prudent.
Prudent. That's CFO speak for we need to hoard some cash just in case.
Exactly.
Before we jump to the Q&A, they also announced some restructuring starting April 1st. What's the goal there?
It's about simplifying the organization to fill what they call the white space.
White space.
Essentially, parts of the customer's wallet they aren't currently capturing. So they're reorganizing into 3 new segments. Landside, which is inland transport, forwarding for air freight, and solutions, which is the supply chain management and warehousing side.
Trying to sell more services to their existing customers.
That's the goal. Make it easier to sell those add-ons and improve margins.
Okay, that sets the stage perfectly. Solid 2025, a potentially scary 2026, and a new structure to navigate it. Let's transition to the Q&A. This is where we really see what's keeping analysts up at night.
Let's do it.
First up, Muniba Kayani from Bank of America. She went straight for the elephant in the room, that guidance range and the Red Sea.
A crucial question to start with.
Yeah, she wanted to know how the timing of a reopening impacts the low versus the high end of their guide.
And Vincent Clerk's answer really highlights a paradox in shipping right now. He said the guidance depends on how quickly the industry deals with overcapacity, which is about 4% to 8%.
So, paradoxically, does peace in the Middle East actually mean bad news for shipping rates?
In the short term, economically speaking, yes. He explained that a fast, full return to the Suez Canal would actually pressure freight rates more.
Because all those ships currently going the long way around Africa suddenly become available.
Exactly. You effectively add massive capacity back into the market instantly. A gradual return is easier to manage. He even said that hitting the upper end of their guidance, the profitable end, relies on the industry starting to scrap old ships.
So they need other carriers to take ships out of service.
They need discipline.
Okay. Next, we had Christian Nedelcu from UBS with a two-parter. First, would Maersk consider selling a stake in their terminals business like CMA-CGM did?
The answer on that was a firm no.
Really?
Yeah. Management said their balance sheet is strong enough that they don't need to sell the family's silver to fund returns. In fact, he argued the world needs more greenfield terminal capacity, and they plan to build it.
Interesting. And the second part of his question about M&A.
Right. Does that prudence on buybacks also apply to buying other companies?
Are they on the hunt?
They're keeping their powder dry. That was the phrase used. They want to save cash for counter-cyclical moves.
Yeah.
Buying when things are cheap, but they're open if the perfect opportunity comes along. Just not rushing.
Got it. Then we had James Holland from BNP Paribas. He asked about Maersk being a first mover back into the Red Sea.
Management actually corrected him there. He said, hold on, we are a second mover.
Oh, okay.
He pointed out that other carriers, specifically CMA, CGM, have already been transiting. Suez transits are already up 50% year on year.
So how do they see it playing out?
They see phase 1, which is escorted vessels as safe, but it's limited by the number of naval escorts. A full return requires the geopolitical temperature to drop enough so they can go through without military support.
Makes sense. Okay, moving on to Lars Heindorf from Nordea. He pressed on that share buyback reduction to $1 billion. What was the logic there?
The outgoing CFO explained it as a balancing act. $1 billion is still a lot of money to give back, but they need to preserve cash to invest in growth and fleet renewal during a downturn.
It's about protecting the balance sheet.
It is. They are very focused on maintaining their solid BBB credit rating. They don't want to leverage up just to buy back stock when the ocean market is flashing red.
Next was Jacob Lex from Wolfe Research. He asked a great big picture question. If the market stays oversupplied, are there other cost savings levers beyond Gemini?
Basically, how do you save money if you aren't making it on rates? Vincent Clerk was very clear. He said yes, 3 main levers.
Okay, what are they?
First, time charters. Maersk rents a lot of ships. Those rental rates are high now but will fall so they can renew them much cheaper.
Okay.
Second is procurement. He used the phrase hardcore negotiation to force suppliers to lower their prices.
I noticed that. Sounds like suppliers are going to feel the squeeze.
They are. And third is productivity, specifically scaling AI tools to cut organizational costs.
Then we had Alex Rieving from Bernstein. He drilled down into the Gemini numbers. He noted they saved $310 million in Q4, but the annual target is over $1 billion. He asked about the timing of those savings.
The company clarified that Q1 savings will likely be lower because of seasonality.
Chinese New Year.
Chinese New Year, exactly, which slows everything down. But the key message was about consistency. The savings come from burning less fuel and turning assets faster. And they reminded everyone that Gemini is currently only half the network.
Ah, so there's more to come.
Yeah, future growth involves expanding these principles to other areas, like stabilizing Latin America with a new hub in Panama.
Alexia Dugani from JP Morgan asked a very direct question. Is Maersk interested in any shipping M&A?
But she got a very direct answer.
No, just flat out no.
Flat out. Shipping M&A is not the focus. Strategy remains growth in infrastructure, terminals, and logistics. For shipping, it's purely about fleet renewal to stay competitive, not buying market share.
Next up was Arthur Truslow from Citi. He asked if the ocean loss in Q1 2026 should be much different from Q4 2025.
Management pointed to two specific headwinds for Q1. First, contract resets. A lot of contracts renewed January 1st or February 1st at lower rates. And second, again, Chinese New Year means lower volumes. So, yeah, they're bracing for a tough start.
Then Parish Jain from HSBC asked about the start of 2026. How are rates and volumes looking, and what's the sentiment from U.S. customers?
On the first part, the company confirmed rates are continuing to slide, and Q1 is seasonally weak. But the answer in the U.S. consumer was surprisingly positive.
Oh, really? Given all the inflation talk, that's interesting.
Yes, they said sentiment is strong. They're expecting a robust 2026 in the U.S., partly due to the midterm elections and fiscal stimulus. They are not seeing signs of weakening demand there.
That's a major silver lining for the global economy.
It is.
Ulrich Buck from Danske Bank asked about volume growth. Since Maersk outgrew the market, will they beat the 2-4% guide? And how will they manage capacity if the Red Sea reopens?
On volume, they said their goal is just to tag along with the market. They're not trying to aggressively steal share, which, just leads to price wars. On capacity, they just emphasized flexibility. If capacity floods back, they'll manage the bottom line by returning rented ships, scrapping old ones, or using slow steaming.
And the final question came from Marco Limite at Barclays. He looked further out to 2027 and 2028 with all the new ships coming online. He asked about profitability and if there's a rate floor.
This led to a very, very sobering outlook to end the call. The CEO predicted 1 to 2 years of pain.
Pain. That's a strong word for an earnings call.
It is, but he believes this pain is necessary to force the industry to scrap old vessels, many of which are over 26 years old and just uncompetitive.
So what's the floor for rates?
He defined it as incremental cost. Basically, rates will drop until it costs carriers money to move a box. He said the industry just needs discipline to resolve this overcapacity.
So bringing this all together, if we had to summarize the main themes from this call, what are the core takeaways?
I think there are 5. First, operational strength. Despite headwinds, they had a strong 2025, led by terminals and those Gemini efficiencies.
Right, they are running a tight ship.
Literally and figuratively. Second, Gemini itself is a huge success story. They're targeting over $1 billion in annual savings.
Okay.
Third, the 2026 challenges. A clear warning of a difficult year with falling rates and overcapacity. Fourth is financial prudence.
The reduced buybacks and that hardcore negotiation.
Exactly. Weathering the 1-2 years of pain. And the fifth,
Strategic consistency.
that's it. No to shipping M&A, yes to growing logistics and terminals. They aren't panic-buying competitors. They're building infrastructure for the long haul.
It sounds like they're hunkering down for a storm but feel confident in the ship they've built.
That's exactly it. They have the balance sheet to survive the pain that might bankrupt smaller or less efficient players.
Well, that brings us to the end of this deep dive. Thank you so much for watching the video.
Thanks, everyone.
If you found this breakdown helpful, please click like, share it with your colleagues, and subscribe to the channel. Stay tuned, because we will have a lot more content coming your way as we track this market. Thanks for watching.